Hi, I'm Steve Spencer from SMB Capital, and today we're going to talk about a bounce trade in commodity ETF, GLD, which is representative of the gold futures. So I don't trade commodities, the commodity ETFs that often. I've done some videos on oil. I've probably done a couple of videos of gold over the years. They're very different. They're very different than trading stocks for a variety of reasons. But occasionally, when in my view they get stretched to extremes, I'll look for a trade. And so I just want to kind of walk you through a few points, maybe why they're different than stocks, and kind of walk you through the trade that I started today, and some thoughts about where this might go and kind of what I'm looking for. So commodity is not the same as stocks. I mean, basically, in the case of something like gold, it's a metal which has, in my view, no intrinsic value. It's not something that's really used in the economy. For the most part, perhaps small amounts are used in certain industries. Gold is popular in India, where they use it for a lot of jewelry. But overall, for the amount of gold that is produced, there really is no real use. It makes it different than a commodity like oil, which oil actually does have a real use in the economy, global economy. And so there are some supply-demand factors that can move the prices quite a bit. But gold, for the most part, it's really driven by market participants who have decided that they're willing to step in and buy at a certain price or sell at a certain price on whatever. And so it really is a bit of a guessing game. And so when I do get involved in something like a GLD, I'm very mindful of my stops. I'm very mindful of when I hit profit targets, taking sales and really being very disciplined about the position. It's very different than something like, a Facebook or an Apple or Microsoft when it comes down to prices, where I know there's a certain amount of cash flow there, there's a certain amount of earnings there, and there's going to be people willing to buy for those reasons. So let's take a look at the setup. Here's gold on the weekly. At the beginning of the year, it was still in a multi-year downtrend. We're looking at the weekly chart, and it actually bottomed around the same time as the market overall at the beginning of the year. That first weekly bar that I've circled, where it has a strong thrust upward, is in February of 2016. And you can see that second bar where it has another big move up, it breaks that weekly downtrend. And so there were some hedge funds, I think, at the beginning of the year that piled into gold for a variety of reasons. And it really looked like it was going to get back up to the high 130s where it had topped out, I think, August of 2014, before recently starting to sell off again. And so we look at this weekly, it really had started to come off probably about a month ago, had popped back up right before the election and was in the 124, 125 area the day after the election, and had come off about 10%, approximately 10% since then, and had come back down into an area where you can see on the weekly, it was starting to kind of gap fill that February area where it had ignited to the upside. So it caught my attention. If we drill down into the 30-minute, you can see on the 30-minute, after it topped out going into 125 the day after the election, it came down to that 119 area. 119 is an area where early in the year when it was in an uptrend, I had a couple of times successfully had bought it there, but didn't even really cross my mind this time to buy it. The way that stocks were going up, and I just figured it would come off some more, and if it came off a few more dollars, I might take a look at it. It caught my attention this morning, below 115, was down a couple of bucks. And what I did was, and I tweeted this out around 10:30 this morning, that I was starting to nibble on GLD and TLT. TLT for other reasons, but we're just talking about GLD today. And I wanted to kind of walk you through from an intraday price action perspective how I was thinking about it. So I have three different points here. The first was it was coming down into 113 from 114. I bought a little bit just to keep an eye on it. Where I really wanted to buy it was in the 112.60s. What I found quite often when I've traded GLD, when it's flush below a whole number, it'll go down into the 60 to 70 cent range, probably related to how it's trading in the futures market. And if I can capture it in the 60s and then very quickly gets back above the whole number, I have a very easy intraday trade. and perhaps I can use that area as kind of my benchmark for a swing trade in the coming days. And so I nibbled into 113. I think I tweeted it out when it was in the 112s, maybe in the 112.80s. I was able to get it right into that second point. I was bidding at 112.65. I couldn't get hit. I was actually watching it when it got down there. And so I raised my bid a little bit. I think I got it around 67, 68 cents, something like that. And then I was looking to see if it could get back above 113 and hold. And it did that probably within 30 minutes or so. And eventually started to hold above 113. This is the more conservative spot where people probably started to get involved around 113.20. So that's kind of from the intraday execution standpoint. Comes into the whole number, watch for a flush below the whole number, look for it to get back above. What I'm thinking, my mindset from the swing perspective now is a couple of things. Can it come back and test that area, maybe make a little bit of a higher low? Great, happy to add there. But I would like to see it now from a swing perspective, ride this thing from the 112.60s back up to 115 and a half, 116, something like that. That would be around a $3 move from where I got in the 112.60s. I think the risk in that area there was probably in the 50 cent to $1 range. So if I can capture $3 of upside from that area, it's a pretty good risk reward. Willing to change the thesis. Again, it's very different than oil. I've made some videos on oil earlier this year, explained why I thought eventually it could work its way to $55, $60 a barrel, because there are some real fundamental macro reasons. Gold it's a different beast. It really does come down to, what it really comes down to? It comes down to this. There's trillions of dollars of excess liquidity out there, and it's looking for a home. We've seen as it's shifted into US small caps over the last few weeks, how quickly it's moved to the upside. So for me, GLD is kind of a play where they've piled into the stocks and they've actually piled out of bonds. I think money will start to come back into bonds. That's why I nibbled in TLD today. But this is really a story. If this is going to have a bigger bounce and work its way back up to 120 to 130, it's most likely going to be because people have run out of things to put their money into. But it's the thing that I trust the least and why I'm most cautious in terms of how I enter the trade. But hopefully you were able to take away a couple of things from kind of how I looked at it today. I did give you the heads up when it was pretty close to the low. We'll use those levels and I'll talk about the trade as it develops in the coming days.